Hi everyone, my name's Darryl Panes, CEO of As Good as Gold Australia. And today, once again, I'm joined by my brother Brian and partner.
Good afternoon, Darryl.
At As Good as Gold. And today we interview John Adams, Chief Economist at As Good as Gold Australia. Good afternoon, John.
Good afternoon, John.
Good afternoon, Darryl and Brian. How are you going today?
Well, we're going very well, John, as I'm sure you. You are creating havoc out there at the moment. All around the world. Not to say that you haven't done that from time to time previously, but now more than ever, it doesn't matter whether it's YouTube, whether it's Twitter, Facebook, you seem to be everywhere at the moment, John. Congratulations on that. I do believe, in fact, that John has a couple of interviews coming up where he's been asked to be interviewed by people like, well, in fact, Jim Sinclair, Bill Holter, Jim Sinclair from jsmindset.com, one of the legends in the industry, of course, Absolutely. And we refer to him quite often. So John's been asked to be interviewed by Jim, which is fantastic. And of course, the one and only Robert Kiyosaki from Rich Dad, Poor Dad. So it doesn't get any better than that, John. You've done very well.
Well, what I can say, Darryl, is that over the last month, a lot has happened in the silver market. A lot of it's been emanating out of Australia. So I've been at the forefront of informing the global community about what's going on, and we've definitely caught people's attention.
You certainly have, and of course, this has all been brought about by your reference to physical silver versus synthetic silver, and how it relates to several bullion ships around the world, particularly here at the Perth Mint, Kitco, and they're both huge mints, but and the impact that has taken place because of your comments. And here's what I do know is this, and this is what it's all about. For years, Brian, you and I have received, when we have a customer call for the first time, or a prospective customer call for the first time, and they know nothing about precious metals. They very often, they tell us that. And they say, we've done a bit of research, and because of the environment at the moment, because we feel unstable, uncomfortable, we want to look at precious metals. But we really don't know a lot about it, so you could explain it to us. And so it's not a complicated industry, but there are some people out there who make it complicated.
Yeah. There's really only two suggestions here. It's either yellow or silver. You buy either one.
Well, that's right. And as long as it weighs what it says it does on the bar and it's 99.9, then it's gold or it's silver. But hey, here's what's happened. What John's done is highlight that there are differences between, let's say, taking physical ownership of the metal, having allocated metal, having unallocated metal, pool allocated, ETFs. So there's a number of ways that you can purchase physical gold and silver. And so John's uncovered something here and highlighted the difference between all of these. So what I want John to do right now, if he could, is explain, because this is really important, explain to precious metals clients all around the world the difference between all of those that I just mentioned. So if you could do that, John, I think it'd be a great start.
So probably where I'll start off, Darryl, is that before I just go through those particular definitions, I mean, you are correct in saying that this is a really important issue for the market around the world. And one thing I will say is that I'm coming on 3 years with As Good as Gold, and we've been on a very interesting journey in terms of the three of us. But as I've engaged with members of the public and in terms of our clients, one thing I've noticed is a lot of Australians have put their money into some of these synthetic products, and they didn't understand what the differences are. And last year I wrote an article on my website, adamseconomics.com, where I sort of said beware of gold, beware of synthetic gold and silver products. And obviously, since the silver squeeze movement has started, we've actually highlighted this issue time and time again. whether I've done shows with Martin North or on Twitter, etc. And so now it's sort of created a big global talking point. So obviously this is very big for the Australian market because the two biggest players in the market provide a lot of these synthetic products. So just to go through what these actually mean. So obviously, if someone was to buy a kilo of silver, for example, and take that, put the kilo in their hand and walk away with that kilo, that is what I call physical direct ownership. So they actually, that is their legal property, and they have full legal rights over that. And that's obviously one way that As Good as Gold, how we do business with our clients. People can come in terms of meet in Adelaide, or whether we do sort of direct shipment to clients, they can actually have a physical gold and silver in their own possession that they hold. It's their legal property. So that's physical, what I call physical ownership. Now, when it comes to allocated, so sometimes dealerships like As Good as Gold Australia will say to customers, if you would like to buy gold and silver, but you don't have the facility to hold it, well, we can hold it for you, and we have a vaulting service. And some of our clients have taken up that offer with us. And there's obviously a range of vaulting services right across not only Australia but around the world, and that is what we call allocated. So the key important thing with this, Darryl and Brian, is that when a customer of ours has their gold or silver in our vaults, it is still their legal property, but we are the custodians of that. So we are holding that property for them. And when that gold or silver goes into our vaults, we provide an inventory statement to our client, and that that inventory statement is a legal record of their legal property. But at the end of the day, it's not our property; it's the client's property, and that's what allocated means. Now, I should say that in the American context, if someone for our American viewers, that sometimes they talk about allocated and in terms of segregated. So segregated is that that property is labeled under a client's name. So in the Australian context, if we have a client who has bought gold and silver, we put it in the vault for that client's behalf. By definition, it's both allocated and it is segregated because it is split apart and put under a client's sort of individual identity. So and what I should say is that's all As Good as Gold does. We either sell gold or silver and that people can pick up and physically walk away with, or we put it in the vault. But then you get into some of these synthetic products where you don't technically legally own any gold or silver, but you supposedly have price exposure if the market price goes up and down. So let me talk about what they call pool allocated. So in the context, for example, in the Perth Mint say that they have effectively a warehouse full of 1,000-ounce good delivery bars, which are approved by the LBMA. And rather than actually buying a specific bar and owning that bar, you put money in a pool in terms of like a bucket of money, and then you have exposure to that pool. And so as the price of gold silver goes up and down, well then you have the exposure to that price if you actually ask for your cash back. So when you ask for your cash back, you're actually getting the adjustment in the market price. Or the alternative is you can actually stand for delivery. And about a month ago, the commitment by the Perth Mint was 10 days for pool allocated. So that's what pool allocated means. So there is, in the context of Perth Mint, a warehouse full of 1,000-ounce silver bars, and you have an interest in those bars, but you don't legally own a specific bar itself. Now, when it comes to ETFs are a legal structure. And so when you buy into an ETF, again, you don't legally own a specific bar or coin of gold or silver, but you actually own a share of a legal structure. And that legal structure claims that they have underlying assets. And there's ETFs that are for all sorts of commodities and assets across the world. But in terms of the gold and silver space, so an ETF will say that they have gold or silver on hand. It's put away in some sort of vault, and the value of the trust goes up and down requisite with the value of gold and silver as it goes up and down. And obviously one of the problems in terms of ETFs is if they run into problems in acquiring enough gold or silver so actually, let me take a step back. So there's a legal document that actually defines how the trust actually works. It's called the prospectus. And typically what happens is as more funds come into the trust, they will issue more shares, but their commitment in their prospectus is that they'll actually put more ounces of gold and silver in the vault consistent with those shares. One of the problems that happened in early February with the start of the silver squeeze was that the SLV, which is the largest ETF for silver in the world, what they call iShares, they couldn't get enough silver to meet the demand in terms of the inflow of funds. So they changed their prospectus, and basically they admitted by these changes that there was going to be a mismatch between the number of shares on issue and the number of ounces in the vault. And that was, in my personal view, a default, because they basically broke the commitment that they had made to the market. So there are some of the risks involved in terms of ETFs. And obviously the most important thing is with an ETF is if for some reason the ETF goes bust, well, then you don't actually have any gold or silver. All you have is ownership of shares or units in a trust that basically has no underlying value. And then you go to unallocated. And unallocated in the context, again, in terms of the Perth Mint, is that they have silver or gold in raw form that they use as part of their working inventory. And you can buy a share of that. So you're not owning any specific ounce or gram of gold or silver, but you're owning a share of this raw silver or raw gold. And as the pricing goes up and down, then you can enjoy that price exposure. If you want to take physical delivery, well, then they actually have to take that raw silver and manufacture a bar or coin, and that obviously takes time. About a month ago, again, the commitment was 10 days. But then obviously what we've sort of seen, particularly in March as well as April, is a number of these organizations that provide these products, they have struggled to meet their obligations to the market to produce the requisite gold or silver within the time frame that they initially had promised.
Which is why I am old school. Always have been. I've not always been old, but I've always been old school. If you don't hold it, basically you don't own it. You've surely got to take on physical metal. I mean, the reason I got involved, and as did you, Brian, that we got involved in precious metals was to secure our future. Okay, so it's a safe haven investment. So to protect our wealth. And I don't think you can do that comfortably with any other means other than taking possession of physical metal or having it vaulted securely in a private vault. That's your only two options, and the only two that you and I have ever used.
Yeah. It's a very similar thing to having a mortgage on a home. You actually you don't own that home until the mortgage is paid off. So if something goes wrong, the bank or the financier can whip that away from you. So it's just a matter of whether you feel comfortable in being able to have that physical or have somebody else look after that. That's a paper contract. So great description there, John. I think that that description should make a lot of people think about what type they go for. Darryl is correct. We started buying our gold and silver in 1997. And every ounce is owned by us, and we have it in physical form. So my question, John, is, after listening to you there, what would you say are the main risks with synthetic silver which investors should be aware of? How have these risks manifested themselves at organisations such as Australia's largest mint or other bullion dealers?
So probably there are two or three types of risk. So obviously, in terms of these synthetic products, if you legally don't own any specific bar or coin of gold or silver, then you expose yourself to counterparty risk. So the types of counterparty risk is if you own an interest in a pool or unallocated, and you want physical. The risk is that they can't produce the physical either at all or in the time frame that they legally have obliged you to come up with the gold or silver. So that's one form of risk. The other form of risk is that if you seek a cash redemption, they don't actually have cash on hand to pay out all of the people who actually have who actually have put money into these products. I mean, there have been from time to time around the world examples of people running into problems with these unallocated and pool allocated accounts. I was listening to an interview as I was coming into Sydney this morning. There was Ed Steer. He gave a particular interview, and he quoted Ted Butler from, I think, 2005, 2006. So there's definitely been a chorus of people in the industry for about 15 years warning about these types of products and in terms of the risks. Perhaps one of the problems, Darryl, Brian, I should say, is that in the last 2 or 3 years, particularly in the Australian market, we've seen a lot of new investors come into the space of gold and silver, may not necessarily understand what the differences are between these various products, but also not only in terms of what their own legal and financial risks are, but also what are the implications for the global market. And so as I've been trying to educate people through a number of articles and messages on social media and interviews, perhaps I can proudly say that perhaps in the last 5 to 6 weeks, of the stories I've been told by either our clients directly who have come across to us or stories from around the world, maybe about 25 tons of synthetic silver has been converted to physical, and that's obviously provided investors much more legal certainty about their legal property. David Morgan the other day said that I've helped a lot of people in terms of protecting their own wealth and their own portfolio.
Craig Hemke, you know Craig Hemke, don't you?
Yes. Look, so Craig and I did a roundtable last week.
Yeah.
And I think about 3 weeks ago, he actually interviewed me for his TF Metals Report website. So we've had a number of decent chats with Craig. Yeah,
a very knowledgeable guy. 2nd of February 2021 this year, Craig Hemke, writing for Sprott Money, suggested that the first crisis wasn't going to come from the COMEX in London, New York, but more likely it would be from Perth, Montreal, or Zurich. And he specified what would bring it about would be unallocated accounts. Now, 6 weeks later, he's been found to be very correct with the silver crisis, in particular as it occurred here in Perth at the Perth Mint. So my question is, how did Craig forecast this scenarios correctly? And then what insights does this provide investors moving forward?
One of the claims, so of those people who put these products out into the market, particularly on unallocated and pool allocated, a number of the people who issue these products say that they are 100% backed. And that, for example, for every ounce that investors put money into, they have the requisite ounces of gold and silver stored somewhere. And if everyone who had this product asked for silver or gold, they would have enough gold and silver to meet all the investor demand. Now, that claim has been disputed by a number of people in the industry, and even in terms of myself, I've made a number of public comments about the Perth Mint. So one of the things we revealed, Martin North and I, last year was that according to a Freedom of Information request that came out of the Reserve Bank of Australia, the Perth Mint borrowed 11 tons of gold from the Reserve Bank of Australia, in February of 2019, the Reserve Bank of Australia testifying to federal parliament said that when they lease gold, when they lend it out to another counterparty, the gold physically does not move. Now, the question you have to ask yourself is, why would a manufacturer and a retailer, as in the Perth Mint, why would they borrow gold that doesn't move? My proposition or hypothesis is that they're using commercial lease agreements to help justify their position when they say their products are backed. So when they offer a synthetic product, they don't have all of the gold and all of the silver, and they're making up the difference using these in terms of these lease agreements. And so so I have made the allegation that Perth Mint is running a fractional reserve synthetic program in terms of these products. Now, I'm not the only one making that claim. So there's a number of people across the world in the industry who have said that a number of these organizations, like Perth Mint, like Hemke, like others, who don't have all that they promise, and that while if a number of investors basically stand for delivery, they can meet that demand. But if they have too many stand, well, then they're going to run into problems. And that's obviously what Craig Hemke was saying on the 2nd of February in his Sprott Money article, that this silver squeeze crisis was going to first manifest itself either in Perth, Montreal, or Zurich. And since this situation has sort of started, Darryl, I've had some conversations with a particular journalist here in Australia who has been obviously getting official statements from a number of people in Perth, and all and obviously the in terms of the message from the Perth Mint is that they are swimming in silver, and that everything is fine. So one of the points I've just made to some people who are naive about the market and the industry is, well, how could one of the best analysts in the world, Craig Hemke, forecasted there was going to be a problem in Perth 6 weeks before it actually happened? The allegation that there is a fractional reserve system with these unallocated accounts. I think Craig, the fact that he could forecast it well before it actually happened, that gives greater weight and greater evidence to those who say that that these products are not 100% backed, and that's obviously one of the other risks is that, and kind of like what I just was saying in my previous answer to Brian, is if you buy a synthetic product and then you want to convert to physical, well, in ordinary times, in small numbers, you can. But if these products are not 100% backed and a lot of people stand for delivery, then you're going to run into problems. And that's definitely what we've seen in Perth over the last 6 weeks.
I've got a question here, John, and I like the answer. But I've got a question here, and I'm going to listen intently, John, to your answer, because I think we can continue on with it. Because I over the last couple of weeks, I've been thinking about this unallocated and allocated and the strife that we can get into. It sounds a bit like, to me, fractional reserve banking in our institutions. But before I do, what you just said then, it sounds to me like March 30th of this year, I think it was March 30th and April 1, when a lot of the big bullion dealers were just absolutely sold out of silver. Now, if that happened in the United States, and I know we were incredibly busy in those few days there, so it happened here in Australia, I think the Perth Mint may have run out of silver as well, and they are clutching at straws actually to get some of that silver inventory in. Anyway, my question: despite significant demand for physical silver around the world, we have continued to see the price of silver lag. It's unbelievable. Everybody's desperate to get it, and yet it doesn't go up, or doesn't go up at the rate I think it should go up. What should investors take away from the recent price action of silver, and how should investors analyse the market to gauge where the price of silver may go into the future?
That, Brian, I think is a very important question. So I've had a number of inquiries from our clients about why is it that since the silver squeeze movement has started, the price of silver initially went up. It spiked from about $27 US an ounce up to 30. And then it's fallen all the way down to 24. And yet we continue to see evidence of shortages, particularly at the retail level. But even in terms of the wholesale level, we are seeing some issues in London. We're seeing some issues in the United States as well. And even in terms of the context of the Perth Mint. Look, there was a story that I broke last week where certain customers standing for delivery of unallocated were not given Perth Mint bars, but they were given bars fabricated overseas. And now we see comments made by Perth Mint staff saying that there is a shortfall, and that's why they have to rely on overseas bars. So obviously we are seeing chronic shortages, and yet it's not responding in the price. And so there is a big debate happening, particularly on YouTube, between those who say that the market is manipulated and rigged, and there's a whole bunch of other people that say that the market is freely traded. The key thing I think for our audience to know is that the price of gold and silver is set at COMEX in New York, and the COMEX futures market, yes, they do have a warehouse, or they have multiple warehouses and vaults full of silver, but the volume of silver that's being traded using these paper contracts is not a one-for-one match in terms of the physical market, and that's how a big chunk of the manipulation, in terms of that, that is how it happens. Now, when it comes to, okay, so if we can accept the premise that the market is manipulated and it is sort of rigged, so how do we know where the price is going to go into the future? And it's taken me a bit of time to come to the view that people should ignore the price chart, and what people should be looking for is evidence that there are problems with the physical supply, with the physical market, whether it is for gold and silver. And typically when you see chronic shortages, that's an indication that there's not enough to go around at the current price, and that if the price starts to rise, well, that's how you can attract more supply, and obviously any shortages can be resolved. I mean, that's what typically happens in a free market. Now, in February 2021, I wrote an article which is actually published on the As Good as Gold website, and it's called "The Silver Market is Fast Approaching Breaking Point." And the point I made in that article is we saw clear evidence during February that there was stress in the physical market. So we saw, for example, in the retail market, a number of North American dealers being cleaned out. We started seeing the wholesale market with premiums on wholesale bars rising. We saw ETFs, for example, SLV, changing their prospectus because they couldn't get enough silver to meet demand. We saw in London with leasing rates, so when banks borrow gold and silver from in terms of each other, we saw that the cost of borrowing silver from another bank was going through the roof. And then obviously we saw silver leaving the COMEX warehouses. And the key thing on COMEX is the amount of silver in the warehouses peaked on the 2nd of February at 399.7 million troy ounces. And I just looked at the numbers just before we started recording today, and we're like, I think the evidence is we've got about 33 million ounces that have left the vaults, and that's just over 9 weeks. And as we go forward, I think these shortages are going to become more chronic. And you know, the key thing about the price is if we get into the May contract. And the point I'll make there is just so our audience understand how COMEX works is so it works on alternative months. So for silver, the delivery dates where they have to deliver a lot of silver in terms of the people with the contracts who have promised to deliver silver, that typically happens in March, May, July, September, December, and gold is February, April, June, August, October, and December. So now we had the biggest delivery month in the history of the market in July 2020. We had the second biggest delivery month for silver in March 2021. That was about I think about 58.4 million ounces. And so as we go into the May contract, it would appear that there is a number of large parties standing for delivery. Now, we'll have to wait for a couple of weeks to see how much silver is being stood for, but it could be in the order of 65 to 100 million ounces. And obviously, if it's at the 65 million level mark, that's going to be, again, still the second biggest delivery month behind July. But if we get above 86 million ounces, well, then next month could be the biggest month on record. And then the question will be is if you reach a point in which those who have to deliver silver don't have enough, well, then they have to let the price go higher so that they can attract people to sell. And then when people sell, then the bullion banks can buy and obviously meet their delivery obligations. And the perfect example of that is what happened in July last year. So, with the biggest delivery month on record at 86.4 million ounces, the first 2 weeks, the price basically did not. The price basically did nothing. So it was hovering around $18, $17.95 US an ounce. And then within from mid-July 2020 to the end of the first week of August, the price went up 60%, up to $29 an ounce. And why did it go up so dramatically, so quickly? It was because they were short on silver, and they needed to attract. They couldn't get enough silver at $18 an ounce, so they needed to attract more silver to meet these contractual obligations. And because of that, that's why the price ran 60%. And obviously since then, I mean, the price hasn't gone down to 15, 16, 17, $18 US an ounce, kind of like it was before July 2020, but it's been hovering around, the 25, 26, $27 mark the 25, 26, $27 mark in terms of the US price. So as we get into May, what I suspect is, again, if there's a huge amount of delivery being asked for, we're already seeing enormous stress across the physical market. If we see a large delivery, I think they're going to run short on silver. The price will have to run. And I would say, if you look at the price chart over the last 9 months, the price ceiling is probably the key level is $30 an ounce. So I think we're at a very good chance of going above $30 an ounce in May. But if for whatever reason they can deliver all the requisite silver in May, well, then I think as we go into the July contract, they'll probably not be able to keep the price under $30 US an ounce, and we'll obviously have to see what happens then.
John, you brought some very good comments and facts there, and I will add one point. You tell me if I'm wrong by thinking this, because Darryl and I had a conversation. In fact, I called Darryl from my phone, from my car phone, and because I just had this niggling thing in my head. And what it was basically is that I know every bullion client, every person who buys silver and gold, especially silver, because it's such a tiny market, they want to see the price going up because they know it's cheap, right? Well, they believe it's cheap. We know it's cheap. And they want to see, what's keeping it down. And you brought up some very good points there. But I also thought to myself, unfortunately, there's a lot of clients that buy it cheap, but they also buy what we were talking about before, pool allocated, unallocated. And they do this because they don't want to pay for the physical, they don't want to pay for the transport, they don't want to pay for the insurance, they don't want to pay for the warehousing. But they're forgetting one thing. Because they're buying pool allocated, that pool allocated may not even be there. The silver is obviously not there, but otherwise everybody would be able to grab hold of it whenever they like. So if our clients and all other clients who are into the pool allocated or unallocated demand for physical, I think you'll see the $30, John, the $30 an ounce will be $40 and $50 an ounce, because everybody should be wanting the physical in their hand. Forget about trying to save a few pennies. Watch what the silver price does when you actually ask for the physical. Am I right, John?
That's a very good comment, Brian. So I definitely think that you are 100% correct. One of the big points that I'd like to make about this, Brian, is so there are people in the YouTube commentary who have sort of said what we need for the price to go up is we need the big whale, we need the Eric Sprott, the Elon Musk, the Warren Buffett, the Samsung, the Apple to really go to COMEX and actually ask for a big amount of silver delivery, and we're talking the billions of dollars, and that should be enough to push the price higher because of all the fun and games that the bullion banks do at COMEX. Now, one of the big points I'll make is that if you looked at the dollar value of all the synthetic products around the world and you added them up, we're talking at least, I think, $5-6 billion in synthetic products. And if all those all those investors with synthetic products at the retail level, if they all en masse stood for physical delivery, the key point I'll be making a number of interviews is, we don't need the billionaire, we are the whale. So the small retail investor together, united around the world, if we all acted to stand for physical silver, we would break the market and the price would start to shoot up, because the more that retail investors buy, the less there is for other parts of the market, and that obviously will accentuate the shortages, and that will obviously manifest itself in the price of COMEX.
Yeah. And that is why we, at As Good as Gold, don't touch the unallocated and the pool allocated. when you buy precious metals from us, it is fully allocated to your name, whether you vault with us or whether you take delivery. We do not use any other method.
Yeah, good point. And so if investors all around the world decided, okay, we're going to take physical possession of this, or we're going to have the product barred, it's currently unallocated, so we're going to have it barred, and we're not going to worry about ETFs, let's take hold of physical metal, simply there wouldn't be enough. There would not be enough, anywhere near enough in the world to supply that demand. We all know what happens with supply demand. If it isn't there, you can't get hold of it, the price goes through the roof. So, it's in the hands of current investors in real terms and those who intend to consider physical metal in the future. But it's in their hands. They can control this, absolutely, totally. And you could send the price of gold and silver to levels that we've never seen before. It's in your hands. I've got a question on the economy, John. And we certainly haven't seen a V-shaped return to a good, healthy economy. And we knew that was going to be the case anyway. But we still have mainstream media, of course, spruiking and telling us that everything's fine. Our governments tell us the same thing. We're told that real estate's still booming, and we're looking at 10, 15% increase over the next 3, 4, 5 years, as long as interest rates remain low. And that's why people are buying real estate, of course. So, but here's what's happened. Here's what we know has happened. We have a major issue in this country with vaccine and AstraZeneca. They can't get it. We don't have access to it quickly enough. And we've got a lot of people, of course, who have heard suspicious reports that don't want to engage in being vaccinated where they may very well have wanted to previously. So a lot of issues here. Obviously, that's going to, the mere fact that we have problems with vaccination has led to governments being put under pressure again to consider job seeker programs, stimulus packages of all sorts. So my question to you would be, knowing all of that, where does our economy head from here, John? I mean, are we going to go through an inflationary phase in the short to medium future, or are we going to be looking at disinflation? We're going to be talking about deflation. What do you see coming for Australia in particular from here?
A lot of this conversation that we've been talking today, Darryl, is about gold and silver. And we've been talking about the specifics of the market. Now, gold and silver doesn't operate in a vacuum. I mean, you've got to consider what the macroeconomic context is. We have spoken on previous episodes about my call about stagflation. So I said that we were seeing the first elements of stagflation in 2020 here in Australia. And just to remind our audience, this is negative or low economic growth, high unemployment and underemployment, and rising prices. And stagflation is the contradiction of Keynesian economics, because Keynesian economics relies on the Phillips curve, which says there's an inverse relationship between unemployment and inflation. So according to the Keynesians, which is our government and the Reserve Bank of Australia are full of, when unemployment goes up, that's a signal that there's a lack of aggregate demand, which means that prices should be falling. And obviously if prices fall, I mean, that's according to some people that is deflation. Now, the way I like to think about this is we have a global debt bubble. We have a massive Australian debt bubble, our debt bubble is the biggest on record. And so the powers that be will not allow this debt bubble to shrink. Since the GFC, every time we've had a point of crisis, we see central banks and governments spend more and more, and they increase their printing. So whether it's the 2012 sovereign debt crisis, whether it's the repo market crisis in New York in September 2019, whether it's COVID-19 in 2020, or even in late February when the bond market, particularly in both US, Australia, Japan, and Germany blew up because of concerns of rising inflation. what do we see central banks do? Rather than let these interest rates get out of control, they just continue to print more money and for governments to spend more money. They, to have deflation, kind of like what Harry Dent has suggested, what we need is that for the money supply to shrink, to get smaller, we need the global debt bubble to get smaller. And the only way it's going to get smaller is if you start to see defaults. And the powers that be know that if there's too many defaults, that's going to be enough to bring a new global financial crisis, and the crisis could be perhaps the biggest in the history of humanity. And so what I suspect we're going to see, and we've seen this so far, is just ever more printing of money. And so obviously in the Australian context, now what I find really interesting is that just before we started recording, the Australian Bureau of Statistics released the unemployment statistics for March 2021, and unemployment went down. Now, that should not give anyone comfort, because at the end of March, we saw a huge number of factors come together in terms of the ending of job seeker, in terms of job keeper. We saw the moratorium on rent, in terms of rental evictions go away, in terms of rental increases, that moratorium went away, in terms of bank repayment holidays, that all ended. And the estimate is that unemployment in Australia is going to rise from April onwards, anywhere between 100,000 to 250,000 people. More than 5,000 companies are going to go bust, because a lot of these people have been just hanging on because of the stimulus. And we are going to see weakness in the job market, but we're not going to see prices fall because of all of this money printing. And obviously, there was an expectation in the context of vaccines that we could roll out the vaccines in a particular schedule, and that would allow us to fully open up the economy and allow international travel, and we could try to get back to some sort of resemblance of normal like we did before COVID-19 came along. Now, obviously, with the vaccines coming in and all the problems you cited, whether it's the logistical challenges or the health risks, and it's very interesting that I think I read only yesterday that Denmark has now made AstraZeneca, like they've banned AstraZeneca in Denmark because they just said the health risks are too great, and yet our government hasn't been willing to ban AstraZeneca yet. So there are problems with the vaccine, and that means that there's going to be problems with Australia fully re-engaging with the global economy. That's obviously going to drag out some of the current challenges, and obviously that's why the unions in Australia in particular have called for JobKeeper 3.0 to sort of keep some of these businesses alive. So we'll have to see whether that happens or not. But the central point that I want to get to the central point I want to make for our audience is in the context of, is inflation going to go, are we going to see rising inflation? Is inflation going to slow down like some of the central bank governors are saying, or is inflation going to be negative like Harry Dent was going to say? Well, so putting the rhetoric aside, all we know is that the powers that be don't want this global debt bubble to explode or to pop or to implode. And so that all they're doing is just printing more and more money. And we know that through history, whether it's Germany in 1923, Zimbabwe, Venezuela in terms of the 20th, 21st centuries, or even if we go back 1,000 years to the 11th century in China. The ever more printing of fiat currency, whether that's a currency of plastic or paper or whatever you want to define that fiat currency in, it's going to lead to the value of that currency going to zero. You're going to see some sort of runaway inflation, hyperinflation, and that is unfortunately the path we are locked upon, because there is no government, there is no central bank that's willing to take a prudent course of action, because they believe that if they were to raise interest rates and cut back on spending and actually have an economy that has a semblance of a strong foundation with a lot less debt, the process to take us from where we are today to that place is so painful, that the political costs are so great that politicians and central bankers wouldn't be able to survive, and their careers would be destroyed. So we have a whole bunch of bureaucrats and government officials and politicians and central bankers who are desperately hanging on for both professional and personal gain, hold on to their job, to convince everything to convince everyone that everything's okay, and they're just continuing to print, they're continuing to spend, and what I do think we're going to see is, the cost of living has been a huge problem in Australia over the last decade, particularly as unemployment and underemployment will increase in 2021. I think the cost of living is going to be a much bigger factor. And then when you consider that whole macro context, that is why I'm still very bullish about gold and silver, because we have a system, we have a debt bubble, we have governments and central banks that basically just want to keep the show going. And the only way they know how to do it is by printing money and by spending money. And history tells us that that's going to end up in a currency disaster.
Yeah. John, once again, beautifully researched. Thank you so much. Really appreciate the time and the effort you put in today. I know that you've got another couple of interviews, be a minimum, after this one. So it's all happening for John Adams at the moment. Very sought after gentleman. Thank you so much. Look, I'd like to finish by saying once again, and we always bring this up, Jim Sinclair, it just gets back to what Jim's talked about. Physical metal, take possession, become your own central bank so you remain in control of your finances. I don't think there's ever been a better time to take advantage of that, shall we say, quote of Jim's than right now. Great news, of course. John's going to be interviewing Jim Sinclair in the next couple of weeks. Yeah. So, all good. But, and if I could just finish by saying Egon von Greyerz, once again, we interviewed Egon the other day, just a few days ago, and had a fantastic response to that interview. But Egon has always said, when it comes to investing in precious metals, how much do I invest in precious metals? Whatever you can't afford to lose. It's a fantastic quote. And right now, I don't think that quote could come at a better time. Thank you again, John. Really appreciate your input. We also would love to thank our viewers and our subscribers for their ongoing support. We really appreciate it. And until next time, can I say now, stay well, stay focused, and goodbye for now.
Goodbye for now.